How the Fed interest rate hike impacts your stock market investments. If you're worried about how the Fed interest rate hike will affect your stocks, then this video is for you. When the Federal Reserve, Fed, raises interest rates, it's viewed as a sign of strength for the US economy and a signal that inflation will continue to rise in the coming months. What is the Fed and why does it matter? The Federal Reserve System is the United States' central banking institution. In the US, the Fed is empowered to control the nation's money supply by adjusting interest rates. How is a Fed interest rate hike consistent with an improving economy? As the US economy continues to strengthen and the unemployment rate falls, the Federal Reserve will likely continue to raise interest rates. In short, the Fed raises interest rates to slow economic growth in order to keep inflation in check. The short-term impact of a rate hike on stocks. The short-term impact of a Fed interest rate hike on stocks is negative because it raises the cost of borrowing money and makes risky stocks less attractive to investors. Stocks have a higher risk of falling in value, while bonds are a steady source of income. Long-term impact of a rate hike on stocks. The long-term impact of a Fed interest rate hike on stocks is minimal. Many financial advisors recommend investing in stocks even when interest rates are rising because stocks have historically produced a steady stream of income through dividends and stock buybacks. The potential downsides of a Fed interest rate hike for stocks. Another potential risk of a Fed interest rate hike is that it can slow down economic growth and hurt the stock market overall. Final thoughts. A Fed interest rate hike is generally considered a positive sign for the economy. While a Fed interest rate hike is viewed as a negative sign for stocks, it's important to note that the impact of a rate hike on stocks is minimal when put into historical context.